It's true to say that we have never seen an industry in such turmoil and also facing so much change. The first change that we need to prepare for is the code monitoring. That we'll know the code monitoring bodies in June of this year, but all advisors and dealer groups must sign up by the 15th of November so that they can practice from the 1st of July. So we have another monitoring body coming in. But again, I think that's affirming its focus is on ethics. Post-election, we were looking at the loss of grandfathering revenue on the 1st of January 2021, which will have a significant impact on revenue streams for most practices throughout the country. Also, it'll be significant as people are to move from grandfathering to a fee-for-service. So we're likely to see a loss of productivity as there's an internal focus. But that's only part of that internal focus. There's about a significant amount of re-engineering that's going to be required in the coming years. We're seeing increased costs coming through in the area of PI, dealer fees, compliance, and just for the first time emerging is also labour costs that are starting to come through. We've seen significant remediation, somewhere around 11 billion, of which 33% has been paid. The focus of ASIC has increased their investigations by 15%, but also increased their activity in the large institutions by 50%, and also have additional funding of 400 million to do these investigations. Whilst we're still seeing the ramifications within the bank and also the AMP and IWF, we need to also prepare as that cascades down into mid-tier and lower tier boutiques. We're seeing significant migration continue from the large institutions to the smaller dealer groups and also to self-licensing. And that trend will actually continue at an accelerated rate as we move into an environment where advisors need to nominate whether they are biased or unbiased in the provision of their advice. We've seen movement from AMP of around 7.5%, and that's relatively explainable, but also the market and AMP are waiting for the announcements in August as whether they're going to move away from their BOLA or EBU for the former AXA distribution channels. The other part of AMP though is that they're facing their remediation immediately and providing support packages for the advisors that have received fee for no services. This is one of the advantages of large institutions, because I think this is going to be problematic when we see that cascading responsibility down to medium and small dealer groups. The movement is relatively significant and expected. We've seen the most successful bank transfer ownership, ANZ, through to IWF. IWF has been the largest gainer, and of course ANZ the greatest loser of some 63% of their advisory channels. We've seen significant growth in limited advice through NTAA and also Eastern Group and to a certain degree Interprac. We've seen 22% growth on NTAA. We've seen 51% growth in Eastern and Interprac at 10.5. What we're seeing is a shifting from the larger institutions and with the emergence of independence, and we'll continue to see that over the next 2 to 3 years. The issue for small boutiques is that they're operating on very narrow margins. There's a liability for the fee for no service, and also importantly there's about to be the removal of volume overrides and rebates. This area has been the fuel for the vast majority of dealer groups, and now they need to find ways of replacing significant revenue in new forms. That's likely to be that we're going to see the increase in dealer fees. The estimated cost of delivery to advisors is somewhere between $38,000 to $45,000 per advisor per annum. One aligned dealer group nominated that their cost was around about $70,000 per advisor per annum. Viridian recently announced their pricing where it's $48,000 per practice plus $22,000 per advisor. So a two advisor practice, their base fee will be $92,000. And this is again, I think, going to have dramatic impacts, and particularly on the advisor migration, but also the growth of self-licensing. When we look at dealers, they're going, not only do advisory practices have to change, but the dealer groups have to change. When we look at the provision of services of the dealer groups, it's not just the provision of compliance and education and oversight. It's in a number of other areas, such as business coaching, acquisition and succession, dashboard reporting, collective support, a culture. And we've got also client marketing. A number of these services, when we go through them, and we've identified sort of 30 key service deliveries. I think what we'll find is that many of these services are going to be outsourced, or the solution is going to be in technology. We're going to see dramatic decrease in headcounts within dealer groups as the push to profitability becomes greater. I also think like advisors have to move from percentage-based advice fees, dealers will also do the same. I think what we're going to have is a la carte type services, and you can pick and choose. The futures of dealer groups is probably just as tumultuous as it is for advisory firms. There'll be winners and there will be losers. The landscape is forever changing, and part of that is the liability for the fee for no service. On the fee for no service, you must be able to provide or show that ASIC that you've provided an FDS in the last 2 years. If you haven't, then they will go back 8 to 10 years, and if you've been receiving fees for no service, you have to repay that with penalty interest. Now, dealer groups will also share that burden as well. We're also seeing advisory firms where getting impacts on their revenue streams by product manufacturers turning off revenue, whereby, particularly in the area of corporate superannuation, where they've gone back and said, are you receiving service? And if there's been no response, then they're turning that revenue stream off. The reality is that every business needs to, if they have not already, cut off any fees for no service, and additionally retool to provide annual engagement for the clients and be able to clearly prove service delivery. The mortgage industry faced devastation, and we're fortunate that the Liberal government was returned, and valuations at the moment have maintained. There's still a level of uncertainty, but for most part it's business as usual. Life insurance, there will be a review in 2021 as to the impact of LIF. At the moment, prices are maintaining around their traditional levels of 3 to 3.5. In Haynes' report, it clearly indicated that ongoing service fees must reflect the complexity and volume of the work that's involved. It needs to be a conversation whereby instead of looking backwards and this is what your portfolio did, it now needs to be forward looking and saying, in the next 12 months, we will provide this service and for this explicit price. There will no longer be segmenting of service levels, gold, silver, there was never bronze, but it needs to be this client needs these services and this is what will be provided for an explicit cost. There is significant amount of change required around that, and obviously we've still got FASIA, which is going to really be the big input as to supply and demand and practice valuations. On M&A within the marketplace, the reality, or my reality, was the market froze in September and we waited until the 4th of February for the release. As soon as we knew what the playing field, the market returned not only at its normal level, but at an accelerated level. I've never received so many requests for valuations, nor for sales. I received about equivalent to 4 years of sales in a period of 3 months. Now, this is where people put up their hand and go, get me out of here. My reality has been that it's actually reduced subsequent to that because there's been a level of comfort from the initial, I suppose, knee-jerk reaction of that significant change, significant fear, to now going, okay, well, I'm starting to see potentially my way through this. My expectation is, yes, we'll have more sales coming on, but it still will be insufficient to meet demand. To give you an idea of demand, last month I had 1,800 individual visits to my website. The month before that, 1,600, and back in March it was around 1,400. Yet I'm at my lowest level of businesses for sale. Now that'll increase, and it'll increase in the next coming months, but it still will come back to normal sort of market. Normal market in the last 5 years has been typified by excess demand and lower supply. Now when we get closer to 24, I think we'll flip. But what I'd like to speak to is how to potentially protect business valuations. At the moment, as I said, it's pretty much business as usual. There are certainly predatory buyers in the market who are significantly looking for deflated prices. And there may be one sector that I am really concerned about around this deflation of prices. The vast majority of businesses that are enjoying high profit are still highly desired because their return on investment is greater than 15%. Additionally, they're throwing off excess cash flow after debt servicing. The area that I'm keenly aware of, and there was information that was provided by MLC that was conducted by the Business Health Report in 2019, is actually small businesses. In their qualification of small businesses, their gross revenue was around $280,000. Their expenditure was around $250,000. They're operating at a profit of 7.6%. If we were to use that as an example, and let's say it's $330,000 of recurring revenue and the business was previously valued at $1 million. At $1 million at 7% interest at 10% terms or years, 10 years, you're looking at $70,000 in interest and an additional $100,000 in principal, and so $170,000 debt servicing on that $1 million asset. Now the economy just doesn't work if this business is only throwing off $20,000 of profit. And this is the sector that I believe that we will see deflation in. I think the solution though, and we're already seeing it within Forte licensing, is that we have two groups in Melbourne and now one in Sydney, whereby they're offering collective services, whereby you come into a communal area, you're operating under one license, but you own your own business, your own book, but you're sharing of costs. And therefore we're starting to see economies. It's almost going back into the 70s in the insurance area of super agencies, and I think we'll see that. Or what we'll see is the migration of those practices to being employed, and whereby they're paying their own way with their recurring revenue, but they still have ownership over that book, but also assisting businesses to grow. But I am concerned about valuations because at the moment it's just not meeting economics or making economic sense. There's been some commentators in the marketplace that have spoken about tightening of interest or bank lending within the sector. I've spoken with two banks and also the leading cash flow broker in our industry in the last week. And there has not been a shift in the LVRs. There is more orientation on profit. Some banks have already been excluding the lower end practices for higher end in excess of 1 million, actually about 1.5, where their minimum lending is 500,000 recurring revenue or greater. The focus is recurring revenue, but with our eye to EBIT and free cash flow, which makes sense. However, what we're also seeing is another bank who had previously been lending only into their aligned network are now looking at coming out to the total market. And additionally, we've got two alternative lenders coming in, looking specifically at that smaller sector. Their interest rates are higher, but there is lending. So cash is available. It's still relatively cheap. We've got rising costs in PI, compliance costs, labour, dealer fees. And so and for many practices, there's an absence of organic growth. So the only thing you can do in the absence of organic, and you've got rising costs and you want to maintain profitability or grow profitability, is inorganic strategies such as acquisition. And so again, the commentary that prices are falling, I think in a particular sector, there is definite exposure. But for medium-sized businesses to larger to highly profitable businesses, I do not see depreciation of multiples being applied in those sectors. We've seen over the last, since 2012, a steady increase in profitability. And this is something worth looking at. Again, this is data provided by MLC and done by Business Health Report 2019. What happened post-FOFA? And I remember all the changes in the fear factor then, but the reality was that actually better businesses were built, more sustainable and profitable businesses were built. And I think once we get through this, I think that's exactly the case as well. Valuations in the future is likely to be more around the quality of the relationship that you enjoy with the client. Now, yes, that's going to be on annual engagements. It will be still recurring revenue. And I expect that we're going to be more focusing on EBIT valuations than we are and have historically on recurring. We've seen profit grow from 2012 of the average practice to around 27.6%. Now, to maintain current valuations on recurring revenue, if we would apply EBIT, you need to be growing your profitability at greater than 35, and the optimum is 40% or more. I think we have the ability of doing it. When we have a look at the current industry practice revenue, again provided by MLC and Business Health, 5% are operating on hourly fees, 24% only on fixed fees, 33% are asset-based fees, 22% is commission from risk only, and 14% is commission on non-risk. From a valuer's perspective, I apply a premium to practices that have moved to fixed fee. The reason for that is that they've actually taken out market risk. No, their revenue and profitability is not susceptible to the rise and falls of the market or the economy. The move to fixed fees also moves the perspective of a practice. A practice can be overall profitable, but the reality is you've got some clients in there that are subsidizing others. When you move to fixed fees, you're actually looking at profitability per client. And I think that's a lot better business operation than before. The fear that people have is, well, how do I do it? If I'm breaking down the services, how much do I charge? Well, the thing is that you need to have a look at what services you provide. And for many, that's I provide advice. But if you break it down, I'd think that all businesses provide these types of services. What you need to have a look at is the McKinsey time and motion as to how much does it actually cost you to provide these services when you take it through the production levels of principal, advisor, support staff, paraplanning, and any other interface. And you're working on an hourly basis, but then you build in your premiums to it. My suggestion is that you're looking at bringing in your margin of somewhere around 30 to 40% on the delivery. Significant changes coming, but again, I don't think it's bad. What I think we're going to also see for those that get through the next 5 years is a substantially greater and better marketplace. The first part, yes, there is likely to be less participants, and that in one is affirming for price. 2, there'll be greater barriers of entry with education criteria. But I think with the exit of banks, degree qualified advisors, vigilant authorities, the removal of conflict and improved transparency, is we're going to have the restoration of trust. We're going to win back that trust we rightly had. And then also, coupled that, we're going to actually have better businesses, clear pricing and value propositions. We're operating on profit per client. There'll be, when we're seeing it already, lower platform and technology providers. There'll be, I think, aggregating buying groups. I think this is the evolution of dealer groups, whereby it'll be collective buying groups. And also, in 5 years' time, it could well be that we are in self-licensing environment, much like accountants find themselves as CPAs, CAs, and that's the authority that they operate under, but they also control their own futures within that and their conduct. Also, like the accounting industry, I think we'll see the growth of super boutiques, the likes of, for instance, Deloitte's, but in the parlance of advice, and there's a significant amount of capital and M&A activity going on right now that supports that. There will be greater governance and compliance, potentially as nominated individual licensing, and there'll be better client experiences and outcomes. MLC nominated that there's 2.1 million people, Australians, looking for advice, new advice now. So we're getting a growing industry already. EY came out with a report, their global wealth research. The growth of independent advisors to surge in the next 3 years by 73%. Independent advisory firms to surge by 93%. 40% of Australians to switch wealth providers in the next 3 years. The percentage of assets under management and hourly support are currently the most common payment methodology. However, from a client's preference, they have nominated they prefer fixed fees. Within this report, they also nominated 71% of Australian consumers nominated transparency as a significant requirement. Preference for in-person phone interaction and face-to-face meetings is down 35% from 2016 to 22% in 2018. Only 22% prefer the face-to-face. So with the technology that we have of Zoom and Skype and other mediums for interaction, we actually can create greater efficiencies within our practices if we engage and enable technology. 47% of Australians respondents said they prefer mobile apps. 47 in comparison to 12% in 2016. Australian respondents to use of fintechs likely to increase by 53% in the next 3 years. So we've got a consumer who's wanting to embrace new technology. We're re-engineering our businesses, and when they need to be more profitable, the only way we can do that is by technology. But our clients want to see this new technology coming through. We've got a growing industry at the moment in superannuation, 2.3 trillion. In 2027, it'll be 4.8 trillion. There's 3 trillion of multi-generational wealth transfer that's about to happen beyond the next 5 years and beyond. We have never had the proliferation of technology and choice as we have now. We've never had a greater moment in history to change, but be able to change and deliver greater outcomes. In summary, I am concerned for certain sectors of our advisory community. I am concerned that there is a significant amount of change. The current revenue streams are under threat, but I'm confident that we can and will once again face these changes and build better outcomes for our clients and for the practices overall. I'm confident about the future. It's just this interim period where we need to focus on what needs to be done, not ignore it, accept it, and in some ways, embrace change. Thank you.